Hey guys, I'm currently holding 40% cash and 60% crypto. I've never held 40% cash as far back as I can remember, at least in the last 5 years. I'm going to show you something pretty amazing in this video. First, we have the yield curve. Every time the yield curve inverts, indicated by this red, that is the start of a sequence of events. The next step is the Fed fund rate flattens off and begins to decrease. That pivot where it begins to decrease is the second step in the sequence of events. The third step is the stock market begins to bottom out and crashes to its ultimate final low. 1, 2, 3. And that repeats in both the year 2000 and 2008 housing crisis, where we had the yield curve invert right here. We had the federal funds rate begin to pivot, begin to decrease the interest rates. And lastly, we had the final leg down, or the biggest portion down, and the collapse to the bottom of the S&P 500. That is what I'm going to show you in this video, and we are at the beginning. We have the yield curve inversion. We do not yet have the Fed funds pivot, although it has begun slowing down, as we just saw today in the FOMC meeting, and that will be followed, in my estimation, by a major collapse of the S&P 500 down to new lows that we have not seen for a very long time. Thanks for joining me, guys. This is the highest cash position I have been sitting on in at least 5 years, percentage-wise, of my total portfolio. And I want to walk you through why I am doing that. It's because of my big picture view. And in front of you here, I have TradingView loaded up with 4 or 5 specific charts. I just added a new one here at the bottom, which is a yield curve inversion chart. And I'm going to walk you through a pattern that I see that I'm paying close attention to, and it's the reason why I'm brave enough to be sitting on such a cash heavy position, even in spite of the fact that Bitcoin has already dropped from $64,000 all the way down to about $18,000 where it stands today. So first of all, let me introduce you to the charts. The top chart here is the S&P 500. The next chart is the Bitcoin price. The next chart is the federal funds, the effective federal funds rate, the interest rate that they set for banks. The next chart is the MMTH. This is the percentage of stocks over the 200-day moving average. And lastly, on the bottom here, we have an indicator, which is the indicator showing when the yield curve has inverted. And just to make a note here, this is specifically showing the 10-year, 2-year, and when it goes red, that means it's inverted. Just as a point of interest here, as far as Bitcoin is concerned, today we had the Federal Reserve FOMC meeting in which they determine whether they're going to increase or decrease the federal funds rate here in this teal blue line. And they did. They agreed to increase by 50 basis points, which means 0.5%. Now that's somewhat significant because it's the first time in like the last 5 increases that they've reduced it by only 0.5%. The last 4 or 5 times, it's been 0.75% or 75 basis points each increase. So this was the lowest increase we've seen in a very long time. So that to me indicates that we could be beginning to round the top on the curve of the federal funds effective rate, where they increase it to collapse the economy, and then eventually they decrease it when they feel like they've basically done enough damage. They've put enough people out of employment. They've ruined enough people's lives. They destroyed the economy enough, all in the name of getting inflation back under control, which is something in the first place that could have been prevented by not printing endless amounts of stimulus money, whether it's for COVID, whether it's for Ukraine, whether it's for whatever. Massive money printing, like we've seen in the last couple of years, has led to the out of control inflation problem we have. And that in turn is resulting in the federal funds effective rate being raised by the Federal Reserve to try to curb that inflation. It's very messy, and it basically makes people pay for the government's mistakes. But let's take a look here. So first of all, we have the S&P 500, the top chart. You'll notice that we have been very strictly bouncing off of this upper trend line. And even with a slight bounce outside of that trend line, a deviation, if you will, it's currently well within that bounds. And we are right here So that line has held and continues to hold. And I do anticipate, as I've said in my previous videos, if you haven't watched them, watch the last video I did, if nothing else, that this is going to roll over and make a new low. And eventually we're going to get down to at least down to 3,200, this red horizontal line. I think we're actually going to end up around 2,100 down here, which is the top of this particular support range from 2015 to 2017. Just to give you my big picture view, I think we're going to bounce off of these major support lines and end up most likely down here. It also, just for the record, would not surprise me if we ended up down here at the top of the 2000 and 2008 peaks, the double top really that formed here. That's a very strong support range, and I think that that also makes a case for a potential final bottom. If the 2100 S&P range is breached, then I would say that this is most likely going to be at 1500. But for now, I'm holding to this being my anticipation for the S&P 500. Next, we have the MMTH, which is basically the number of stocks over the 200-day moving average. Anytime that this drops below 10 historically has been a very good time to buy in. I consider this an indicator that I'm going to pay more close attention to later on when I'm getting closer to buying. It's a little more of a shorter time frame indicator. So I want to start with the longer time frame and work my way in as I approach my time to buy. So we start with the longest trending, the biggest time frame indicators and charts first. And really, there's no bigger chart or indicator to me than the yield curve. And I'm going to take you on a quick little journey here. So the yield curve is basically the curve generated right here, literally a curve, by the various US bond rates. Is literally the curve formed by the US bonds and the different rates they have at any given time. And you can see that this was the line in 2021, year over year, and this was 2 years ago, the light gray line. You can see that the curve has inverted, which means that the earlier points on the curve, the 1 month, the 3 month, the 1 year, notably, the 2 year, these four, let's say, are higher than the last points. And it makes the curve actually invert, meaning it goes down on the right and up on the left. It shouldn't be that way because the confidence in the economy should be such that it's like this, where you have people putting their money up and expecting more return for a longer investment. For a 30-year investment, you would expect more return than just a 1 month or 2 month return. And that would be a more healthy curve. It would be up on the right, down on the left. Well, we have the opposite. We have down on the right, up on the left, because confidence is stronger in the short term than it is in the long term, which means that people are expecting not so great things to happen to the economy in the future years. It looks like around 3 years on forward, it's not looking too confident. And thus, you actually get paid less to invest in U.S. Treasury bonds in the longer time frame than you do in the short time frame. So right now, it makes no sense to do a 30-year bond investment when you can do a 3 month or a 1 year investment and get, for example, a 4.6% return on 1 year versus only a 3.5% return on 30 years. So this is called an inverted yield curve. And any time that the yield curve has inverted, it has historically almost without fail predicted a recession to come. And that's what this chart right here shows you. The gray vertical bars are showing you the various past recessions. You can see the 2008 housing crisis is right here, the 2000 dot-com bubble recession right here, and so on back through time. And right before every one of these gray periods, these recessions, we had an inversion where basically this blue line goes below the red line, to keep things simple. Every time on this chart, the yield curve inversion has occurred, indicated by the blue line going below the red line. It has been followed by a recession. And basically we saw a really tiny dip back here in 2019, and then we had the COVID crash, really tiny recession, if you even want to call it that. Flash crash recession. But right now, look what we're sitting on. We're sitting on a massive minus 1.1% spread on the 10-year, 1-year Treasury yield. And that's basically just taking the 2 points here, the 10-year, which is 3.477%, and subtracting it from the 1-year, 4.631%. If you subtract those two numbers, you will get minus 1.154. And you can see that this is the lowest point on the chart all the way back. It's much lower than 2008. It's much lower than 2000. It's the lowest point since the 1980s. This is the biggest inversion in about 40 years. That is a big factor for why I think we are going to see a massive recession. And this is my biggest macro, longest time span indicator. Now, back on this chart here on the bottom, the green indicates that there's no inversion and the red indicates we are in an inversion, as I just showed you. Specifically on this chart, it's a 10-year, 2-year spread. That's just the way I could make this chart work. So the 10-year, 2-year chart is right here. This right here, this chart you're seeing where it's minus 0.74, again, the lowest in 40 years since the 1980s, is the exact same data that you're seeing here in green and red, just represented on TradingView in a color-coded manner. We're right here around minus 0.73, and that matches up here minus 0.74. So this is my number one indicator, and this brings me to the point of this video. And this is what I feel is so important to be noticing. Keep in mind, every time there's an inversion, these red portions of the yield curve, there's a subsequent recession and a crash in the stock market. And that's indicated on this top chart up here. Let me close the Bitcoin, collapse the Bitcoin for now so we can see these other things a little better. Close the MMTH. All right, that's a little better. So here's inversion number 1. And here is the S&P 500 collapse. Here's inversion number 2. Here's the S&P 500 collapse number 2 in the 2008 housing crisis. And look at this. Here's inversion number 3. If you ignore the little piddly, COVID dip, which we did have a crash for as well. So it even held true there. But here's the significant inversion number 3. And so what do we think is going to happen here? Most likely, we're going to have a stock market crash somewhere in the future, somewhere over here. This is 2024, 2025, somewhere around there in the future. Looks likely that we will have a bottom in the S&P 500. Now, I know that's a long time in the future. That's about 2 years away, give or take. And it is a long time because it does take a long time for these cycles to play out. And one thing you might be wondering is how does this play into the Bitcoin halving event? The Bitcoin halving event is going to occur around mid-2024. Usually within 3 to 6 months following that, we get the beginnings of the next bull run up. So if I think that the bottom of the S&P 500 is going to be somewhere 2025, that kind of correlates with where that Bitcoin bull run ordinarily would be. Now, do I think that the Bitcoin bull run is going to be completely negated by this stock market crash? No, I don't think it's going to be completely negated by it, but I think it is going to be massively dampened by it. So just to give you just off the top of my head kind of figures as examples to illustrate what I'm thinking with here, let's say that Bitcoin is $15,000 or $20,000 in 2025. Well, at that point, you're going to have that halving event putting upward pressure on the price because of the supply reduction. However, you're going to also be in the midst of one of the greatest crashes in the last 30 years. So I think that the predominance is going to go toward that bearish direction. But you might have that in that scenario where I said you have a $15,000 or $20,000 Bitcoin price, you might see it bump up to 25 or 30,000 or 40,000 at the top as kind of a peak. And yes, I'm saying that we would not be making new all-time highs, but I think that makes sense given the heavy weighting that the stock market has and influence it has on the Bitcoin price. I don't wish it to be the case. I'm not trying to be a FUD, doom and gloom type person. I'm just telling you what I think I see occurring, in that type of a situation. I don't think that, if we're making lows on the S&P 500 of like 2,000, that we're suddenly going to make new all-time highs for Bitcoin. I just don't see that. I think that people will equally be dumping their Bitcoin as they will be their stocks. I think that the stock market will be equally crashing, as will the crypto markets. Crypto is generally more volatile than the stock market. So if the stock market cuts in half from here, I think that Bitcoin could easily have that effect as well. And the halving event might just help to counter that slightly at that point in time. Now there's a phenomena, and this brings us to the major point of this video, the sequence of events, which to me is like clockwork. And this is why I have 40% cash on the sidelines. And this is why I feel so comfortable waiting for a right time to buy. Specifically, I'm going to be buying Ethereum and some Bitcoin. Those are my two main buys that I'll be looking to make in the coming years. And this is why I might be waiting that long. So, sequence of event number one, we have the yield curve going from a green to a red, indicating an inversion. So we have a yield curve inversion on the US Treasury bonds. That's the first major macro indicator that occurs. The next thing that occurs is the federal funds rate incurs a pivot. The Federal Reserve begins reducing the interest rates. The actual change from either going up or flat to an actual reduction, I'm calling a pivot point. And I've indicated this pivot point with this vertical light blue line. So first comes the inversion, then comes the pivot on the interest rates, and then within a year or two, we have the crash, we have the bottom of the S&P 500. This same exact sequence also occurred in 2008. First, we had the yield curve inverting right here where it went red. Shortly thereafter, we had the federal funds rate pivoting, meaning beginning to decrease after it went flat. And after the federal funds rate pivot occurred, about a year later, we had the bottom of the S&P 500, the bottom of the housing crash. These two cycles occurred exactly the same. And what do we have right now? Well, we have an inversion of the yield curve. And we have a federal funds rate that has been climbing, but slowing as of today. We literally just saw the first time we had a 50 basis points increase versus the 75 basis points increase prior to that. So you can see that we're already starting to form this curve where in the past cycles, it was steep at first and then it flattened off. Well, we're already starting to head toward that flattening off part. It could take a little while. It could take about a year, 6 months here, a year here, something like that. So maybe mid next year, we'll begin ending our flat period. Let's say 6 to 12 months will be at the end of our flat period. Because keep in mind, we haven't even gone flat yet. We're still increasing and just a decrease of the increase. So when we actually stop increasing by 50 basis points and then 25 basis points, we'll go flat probably for a little while. So let's say that puts us somewhere in late 2023. I think that by the end of next year, we'll probably have the final stages of going flat on the federal funds rate, and a pivot will occur where the first time will actually start to decrease and the federal funds rate will begin to decrease. And that will take however long that takes, maybe 6 to 12 more months for that. And after that point, we have stage 3, where the S&P 500 begins its steepest descent, its massive collapse into its bottom, whether that's 2100 on the S&P 500 or all the way down to touching these double tops around 1500 on the S&P 500. I think those are our two most likely positions. I guess I should move this because I don't think this is the most likely. I think that these are our two most likely positions for the bottom of the S&P 500. It would be the double top of the 2000 and 2008 tops forming a support range, or this support range right here, which was pretty strong as well back in 2014 to 2016. And so I think that that is approximately what we will see. Now, given that Bitcoin is so heavily correlated to the stock market, and given that Bitcoin has been invented, let's pull up that Bitcoin chart here. You can see the line starts here in 2011. Really, it was invented in 2009, but exchanges didn't carry Bitcoin until around 2011, depending on what exchange you're looking at. So Bitcoin was a product of this particular crash in 2008, or 2009, I should say, at the bottom of the housing crisis. And that's where Bitcoin was born. And Bitcoin has only experienced a secular bull run. This entire 12 years has just been up, 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 up. Money printing, money printing, money printing, and more money printing. More asset buying, more asset buying, more asset buying. We had one major collapse here with COVID, and that was reflected by a collapse in the Bitcoin price. So if that was any test of the matters, it did not prove itself very well to be very resilient. And so if I believe that Bitcoin is extremely correlated to the stock market, and I believe that the stock market is going to take a major drop down over the next 2 years or so after we have a Fed funds pivot, and that's after we have the current inversion of the yield curve, then I think that Bitcoin has a good chance of going lower than $18,000 where we have it today. I could realistically see Bitcoin hitting 10,000, 8,000, 12,000, somewhere in there. I think that's very possible. And so that is why I am currently positioned 40% in cash. And if I see a bounce higher, if I see a relief rally for Bitcoin up to 25,000, I will take more profits. I will sell more Bitcoin and I will hold more cash because I'm anticipating a drop down to lower levels. And I want to be there scooping up as much Ethereum and Bitcoin as I can, because I think the next cycle is going to be utterly tremendous when the S&P 500 does truly bottom out, and when the Fed finally gets its money printers burring again and pumping and pumping and pumping again. What we're going to see is probably the biggest bull run we've seen in a long time, with more money being pumped into the economy and the economy going vertical, not only in the stock market, but with highly correlated Bitcoin, Ethereum, the cryptocurrencies as well. And I think that we're going to see 6-figure Bitcoin. I think we're going to see 5-figure Ethereum, and that's where I want to be. So for a quick recap, here's my observation. The yield curve inverts. Number one, the Fed funds rate stops increasing, goes flat, and then pivots, begins to decrease. That's the point number two, the pivot. Point number three is the stock market begins to crash and reaches a bottom. Those sequence of events seem to be what is occurring here. And just in case you're wondering, you're saying, well, hey, the stock market's already dropped like 20%. And that's not like these prior times where the pivot rate was coinciding mostly with the top. Well, it's not really true. You can see right here that the pivot actually was late than the top. The pivot point was actually later than the top. And if you scroll back to the 1970s and the 1980s, you can actually see the point being made even more. The top was reached first, and then the stock market began to drop, and only about halfway down did the federal funds rate actually pivot and begin decreasing. And then you saw the final sharpest capitulation, the final sharpest drop in the stock market after that Fed fund rates pivot. So it does hold true. You don't have to be pivoting at the top of the stock market. Go watch my last video where I lay that point out pretty in depth if you have any question on that. Okay, guys, so that's what I'm looking for. I'll be keeping an eye on the yield curve inversion, the federal funds rate, and the S&P 500. And lastly, I'll be looking at that juicy Bitcoin and Ethereum chart where I can pick up some sweet, cheap Bitcoin and ETH. Because remember, Bitcoin has never seen a recession before. And I think we're headed for a multi-year bear market, a multi-year recessional period. And because I think that we are headed for a multi-year recession, a multi-year bear market, I think that Bitcoin's going to have a tough time making new all-time highs until that is over. Someday Bitcoin will decouple. That day is not yet here. Let's keep our eye on the prize. Let's accumulate and hold as much Bitcoin, as much Ethereum as possible. I probably will get a lot of people disagreeing with me because I think I'm very early to seeing this. There are only a few people who are predicting bear markets of such a long duration. And time will prove whether my hypothesis is correct or not. This is just my take on things. Obviously, it's not financial advice. This is how I see the markets. And if I'm right, we'll know in about 2 years from now, or we'll know at least when the stock market is making major new lows. That will be one clue. Thanks for taking your time to watch this, and I hope you appreciated the content. Have a great day.